When you're entering into retirement, there are typically two options for most people, or how they see it would be an annuity or a drawdown. There are pros and cons to each of these approaches, not one size fits all. If you're looking for an annuity, this is where you take a guaranteed and secure income for potentially the rest of your life, but you can take a shorter term annuity as well. The principle behind an annuity is that you take your pension pot, you approach an annuity provider through an advisor like myself, and they'll take some data from you in terms of your age, your health, where you live, etc. And they'll say, based on this, we can offer a rate of X percentage. So if you had £100,000 and they offered a 5% rate, you would get £5,000 per year for the rest of your life. With that, you can choose to add different benefits within. So you could have a spouse's pension, you could include a guarantee or some indexation. In simple terms, these are all different options that your advisor can take you through, and they may be more or less relevant to your personal circumstances. Most people find with an annuity that you get the security and the comfort that perhaps you're used to with your salary, in that every month you know what you'll receive and you don't need to be concerned by the stock market going up and down or anything like this. The disadvantage with an annuity would be that you don't have the flexibility to leave that arrangement. Once you've signed up to it, that's what you will receive for that period of time, whether that's 5 years, 10 years, or your whole life. And often people feel that they want the extra flexibility to access lump sums as and when required. The alternative to annuity would be to use drawdown. So the benefits of drawdown is the added flexibility, but that does come with some of its own risks. So in simple terms, with drawdown, what you do is you retain your pension pot invested in a similar way to what it may have been throughout your working career and life so far. But instead of contributing to it, you're now withdrawing from it. So you would speak with your advisor or consider in your own time what sort of income that you might need. So you might say, I need £1,000 a month to live on. You speak with your advisor and they'll explain to you how that can be achieved. The downside to that is when you have this money invested, you're still exposed to stock market risk. If you're drawing out £1,000 a month and the stock market is maybe not performing as favourably as you would like, you may find that your pension pot begins to diminish over a number of years, and there's always the risk that it could actually run out. Now, compared with the annuity, you don't have that risk because there's no stock market exposure there. You know what you will receive. Whereas with the drawdown, it may underperform, you may run out one day. The benefit of the drawdown, however, is that if you start with £1,000 a month and then 2 years down the line, you find you actually needed £1,200 a month, you can increase that and draw more, obviously subject to how long and how much is in your pot. This may or may not be sustainable, and that's where your advisor can help you with that. But it does have that added flexibility where you can take an extra lump sum at times if needed. The thing is, people kind of get drawn to drawdown through the fact that you can get a tax-free lump sum, and that's what a lot of people like entering into retirement. In reality, you can do both. You could take a tax-free lump sum and then take an annuity, or use half of your pot to purchase an annuity to cover your guaranteed income needs, and use the other half of your pot for something more flexible for maybe future holidays, cars, gifts for family, etc. So each approach has its own benefits, and if you speak with an advisor, they can take you through the good and bad of each and how it may fit your needs.